If you're looking for the most effective strategies to trade price action, I want your full attention, because I'm about to reveal my most important tactics after over 10 years of price action trading. We're not going to talk about support and resistance, candlestick patterns or chart patterns. I will share something more important: how to read price action momentum and how to decode the market rhythm. And if you want to short support, please leave a like to help us with YouTube algorithm and turn on the bell so you don't miss when new videos are released. Traders often have this big obstacle. They aren't able to recognize if the market today is trending or ranging. Here's your first lesson. The moment you recognize what type of day you are dealing with, then you can apply the appropriate methods for trading. If it's trending, pullbacks are the best choices. It doesn't matter whether it's the first or the second pullback, a one-bar pullback or a complex pullback. If it's a trading range day, you only enter at the extremes of the range, wait for a clear confirmation, and stay out of the middle because it can be very choppy. In order to read the market and to evaluate the price momentum, I use price action. The main reason I prefer price action instead of employing indicators is that indicators will lose their powers when the market is not trending. They create all kinds of false signals on a range day. That is a big problem because market is rotating in sideways motion over 70% of the time. One thing I discovered through many years of trading is that trading ranges is surprisingly predictable. The reason behind this is because the market is in a zone of fair value of price, where the buyers and sellers are somewhat passive. Here are several strategies which can help you to potentially tell what type of day is ahead. First, we'll talk about price action during trending days. So number 1, strength and follow-ups. On a trending day, whether it's an uptrend or a downtrend, the bar which initiate the trend usually have decent follow-ups. Market has a rhythm like music. You can sense the urgency in tempo and strength behind every bar when it's forming. One side is dominating the other one, and this should be fairly obvious. In a strong uptrend, the chart is filled with green trend bars, with average size body but closed high. Bars are slowly moving upwards, which can create a parabolic curve. Any pullback red bar is short-lived, with narrow body and long wicks at the bottom. At a glance, they are just simply more green bars than red bars. When a strong uptrend is in progress, it's very hard to make money selling, but for buyers, you should see profit not long after you entered. The price is pushed up and nobody is taking profit until it reaches a fairly strong supply zone. Any counter-trend attempt will fail and becomes the most reliable setup to resume the trend. The wick of the candle is very important in price action trading. It shows both rejection and strength. It's the hidden truth about domination. In an uptrend, you should see long wicks at the bottom of the bars, not on top. It means any selling is being rejected and pushed up. The same principles apply for downtrend. More consecutive red bars with average size body and wicks on top of the bars. Any green bar pullback is small and short-lived. Here we have a very strong downtrend. There are few green bars and many bearish bars. The close of each candle is lower than the previous close. It's in a parabolic curve rather than boxed in. In a trending day, a market controlled by bulls is often characterized by the following bar patterns. First, the obvious one is that we have more bull bars than bear bars. When we see this on our charts, this means that the bulls have more power and are increasingly moving the market upwards. Also, we will see consecutive bull bars. Consecutive bull bars is a clear indication of a bullish momentum. In a bull market, the green bodies are bigger than the red bodies. When we see this on our charts, that's a signal that the bulls have more strength than the bears. Also, during a bull-controlled market, we will see the green bars closing near their highs. This suggests a good momentum to the upside, because the bulls are trying to maintain the prices higher. We will also see a lot of wicks below the green bars. This also represents a good signal that the bulls are in control of the market, and that they are trying to push the prices upwards. When we see the green bodies getting bigger, this signals a clear bullish momentum. Number 2. The old school higher high and lower low. First, The follow-up bars should be breaking out previous bars. For example, each follow-up green bar in an uptrend should have higher low, higher high, and higher close to the previous one. Vice versa for the downtrend. Red bearish bars should be making lower low, lower high, and lower close than the previous bar. Another interpretation is based on the structural pattern, the pivot point on each swing. Price never moves in a straight line, it moves in waves, and each wave will create a pivot point on the chart. These pivot points can often be found in pullbacks of a trend. They are important turning points, which represent zones of demand and supply. The best way to use these pivot points to identify the trend is to create a trend line by connecting them with straight lines. You don't need advanced knowledge to draw complex trend lines. Just connect a low and a higher low and you get a simple trend line pointing in an up direction. For a downtrend, connect any high and a lower high. This trend line gives you both the direction of the trend and a great reference point for support and resistance for future price movement. Number 3. The dynamic support and resistance tool, namely the exponential moving average. I personally use the 20-period exponential moving average on my chart when trading price action because it reacts to price quickly and follows the price action closely. There are many ways of using the EMA, but I found two methods are quite effective. First, I use the 20-period EMA to give me a broad idea of what to expect from the day, whether it's trending or ranging. For trending days, bars usually stay consistently above or below one side of the EMA, most of the time not touching the EMA for hours until a deep correction. For range day, it's very obvious that price interacts with the EMA very closely. Another usage for the EMA is to watch the price action around the EMA when it's touched, and based on the reaction, you find tradable setups. The EMA isn't like a trend line, a straight line. The EMA follows the price, and it serves as a strong support and resistance reference point. But it only works best when price is trending in one direction. When price moves sideways, the EMA loses its efficiency and doesn't produce any reliable setups. As long as the price stays above the EMA, you will only buy, never sell. The opposite is true for downtrend. One of the trade models I employ often is to enter the first deep pullback. In a strong trend, price goes too far away from the EMA and not touching for hours. But when it does for the first time, this deep pullback is a very reliable setup to resume the original trend. Some experts call the EMA the mean. When the price moves too far away from the mean, it can create a rubber band effect, and price would stretch back to the EMA. Traders watching for the EMA know that the probability of the first pullback of a strong trend to turn into a reversal is quite rare. So when price returns to the EMA, they would enter hoping the original trend will resume. Now let's talk about the trading range, the sideways price action. Trading ranges can be very tricky because it's very difficult to distinguish between range and trend. It's understandable because they have some similarities. The relationship between trend and range is that they are interactive. One can survive without the other. Trend is essentially a breakout phase. Range is essentially a consolidation phase. And market is rotating between trend and range. So how do you actually read a price action range? Let's talk about wicks. Trading range is filled with wicks, especially more on top and bottom of the approximate range parameter. The reason behind this is back-to-back failure. When price is being pushed up to the upper boundary of the range, sellers are letting it go to see how far the price can go. The higher it goes, the more profit for sellers when they sell into it. It creates a vacuum effect. When price becomes excessive, sellers will jump in and sell into buyers, pushing the price towards the lower boundary of the range. Entering at the extremes offers great risk-to-reward ratio for traders. You should try to embrace range days because they are somewhat predictable. And the first step, look for many long wicks around the edges of the ranges. Wicks are failures. Top wicks means buyers failed, and bottom wicks means sellers failed. Remember this. A range will have multiple failed breakout attempts before a real breakout. When the real breakout occurs, you can't miss it because it's convincing both in volume and bar size. Any inferior breakout will fail within a short time, generally within 5 bars. Look at the wicks within this range. Observe this area filled with dojis and bars that are overlapping. This bar shows the real breakout of the range. The bar is forceful, large in size, closed high, and with a minimal wick. Number 2. Alternation between bullish and bearish trend. This shows both sides are active. There is no feeling of continuation of either side. There is no consistency in strength. The red bars and green bars are somewhat equal in quantity. The strength is weak. It shines and dies very quickly. Often, you will see a gigantic bar in a range. It will take over the whole space. Then, the follow-up is on the opposite side, so no momentum continuation. And traders trying to trade the first bar are now trapped. Price moved in the opposite direction. Again, there is no sense of consistency. Range days can create a weird feeling that market is not really active, and it feels lazy. But actually, both sides are very active. It creates a balance between buyers and sellers. That's why the price is not breaking out to any one direction. All the setups which worked best in trend trading are now losing their magical power. Remember this when trading ranges. Patience. Wait for confirmation and proof one side is actually failing. Then enter at the extremes. Number 3. Dojis and overlapping price action. When you start to see a lot of dojis and bars are overlapping, market is probably ranging. The dojis are the early signs for range formations. A doji is a 1-bar trading range in essence, and it has many variations. The gravestone, the dragonfly, the hammer, the hanging man. The names are not so important. They are all indicating the same character, indecisiveness. Overlapping price action simply means the size of the bars are either similar or inside of each other. Price is moving sideways, is not going anywhere. Sometimes you will see 2 or more bars having the same high or low. Then you look to the left and you will find past corresponding price action that stopped at that level also. This means there is a strong supply or demand zone for that level. So whenever you see 2 or more bars have the same high or low, mark that level and watch for a reaction when price revisits that level. Look for reliable setups of real breakout or failed breakout. Number 4. The 20 EMA. When price is trending strong and fast, it's hard for the EMA to catch up with the price. Therefore, in a strong trend, there's a distance between the EMA and the bars. In trending ranges, it's the opposite. There's a lot of touching. Because price movement in a range is not very volatile, most of the time is not going anywhere. The EMA cuts through the range, often in the middle. The 20-period EMA is like an axis where price is moving around it. There is one scenario to note here. When a range is about to break, watch the price action closely and you will notice the EMA is somehow holding the bars and push them to the breakout direction. For an upside breakout, the price will stop around the middle of the range, around the EMA. Vice versa for the downtrend. Price will test the EMA and will be pushed to the downside. Being able to read a price action chart is important to make the right decisions. The problem many traders have is that they overcomplicate things and get easily confused, or they don't have a process in the first place and don't know what they are looking for. Now, your job is to open your trading platform, choose one market, and start analyzing price action using these techniques. Just this. I could have mentioned chart patterns like flags or triangles, but these are just ranges. Or I could have mentioned tens of candlestick patterns like inside bars or piercing lines, but again, these aren't as important right now. What's important is to decode the market rhythm, to distinguish a trend day from a range day, and to read price momentum. This is the best price action approach. As always, if you got any value from this and learned something new, Leave us a like to help us with YouTube algorithm, and also make sure to enable notifications to stay in touch when new videos are released. Until next time. Hello and welcome. Today I'm sharing how to find high probability bullish and bearish pressure areas using simple price action, and I will reveal how to day trade these zones in multiple market scenarios. So if you could, like, subscribe to the channel and stick around for the full video. Candlestick shadows can tell you a lot about the market psychology of market participants and should play an important role in your analysis. Long upper shadows are considered bearish shadows. The presence of one or more bearish shadows after a price advance demonstrates that the market could possibly reaching a top. There is not enough demand at higher prices to continue to move the price upward, at least for the short term. Long lower shadows are considered bullish shadows. The formation of one or more bullish shadows after a price decline, especially near support, shows us visually that the market could be reaching a bottom. In this case, the wick indicates that lower prices are being rejected. I've said it in a previous video, markets are traders making trading decisions. If you really want to succeed at day trading, when you look at the chart, don't see it as price movement. See it as traders making decisions. So let's analyze 3 stages of a pin bar from the perspective of other traders. How do traders react to this bar during and after its formation? The best way to examine this price bar is to consider the perspective of traders who transacted at the extremes of the bar. Group 1 sold at the bar high. Group 2 bought at the bar high. Group 3 sold at the bar low. And Group 4 bought at the bar low. Traders who sold at the high of the bar in stage 1 felt like geniuses in stage 2. Then, they quickly became frustrated as the market moved higher and raised their profits. Traders who bought at the high of the bar in stage 1 were constantly watching the bar erode their trading account. Stage 2 was the worst time for them. In stage 3, they felt relieved when the bar ended the way it did. Traders who sold at the low of the bar in stage 2 are in the worst case scenario. The market didn't move a single tick in their favor. Traders who bought at the low of the bar in stage 2 are the happiest. They didn't suffer a single tick against them. So in the case of a large wick candle, we have 4 types of traders. Sellers who are scared, likely to cover shorts. Buyers who are optimistic, likely to hold longs. Sellers who are demoralized, likely to cover shorts. And buyers who are confident, likely to hold longs and even add more. So why is this important? Well, together, they are likely to produce buying pressure. The traders who are short want to cover, so they are creating demand. The buyers want to hold, so they are not supplying, at least not without demanding higher prices. The result is a pressure on the market to move up. So the lower shadow reflects the amount of buying pressure. Your job is to locate the buying and selling pressure zones implied by the lower and upper shadows of price bars. Although in the previous case I used the pin bar as an example, a strong pressure zone is not defined just by one pin bar. To find high probability pressure zones, you must not be particularly interested in how a single bar looks. You must pay more attention to the appearance of a group of price bars. So the buying or selling pressure found on a single price bar might not be sufficiently reliable for a trading setup. Therefore, instead of a single bar, look for at least 3 consecutive bars with overlapping upper or lower shadows. Remember, shadows indicate potential buying or selling pressure. When shadows overlap, they create a price zone that is more likely to exhibit the buying or selling pressure you anticipate. Consider the perspectives of the 4 groups of traders again. When we have 3 consecutive bars with overlapping lower shadows, the traders undergo the same emotional cycle 3 times, all within a compact price range. That price range is the pressure zone we are looking for. A bullish pressure zone is easy to identify. You can mark it out as a zone on your charts. Find 3 consecutive bars with overlapping lower shadows. Mark out the lowest low among the three bars. Mark out the lowest closing price of the three candle bodies, so exclude the shadows. And the area between these two price levels is the bullish pressure zone. To find the bearish pressure zone, find three consecutive bars with overlapping upper shadows. Mark out the highest high among the three bars. Mark out the highest close of the three candle bodies, exclude the shadows. And the area between these two price levels is the bearish pressure zone. Very important, small overlaps of shadows can create unreliable pressure zones. To avoid them, ignore overlaps between a certain threshold. For trading higher timeframes, 1 hour or above, consider increasing the threshold as necessary. Here's the long pressure zone trading plan. Find a bullish pressure zone. Buy above the next bullish bar that overlaps with the pressure zone and closes above it. The third bar of the pressure zone is acceptable if it's bullish. If the price returns once again to the bullish pressure zone and forms another signal candle, you can re-enter. This is similar to supply and demand trading. If price breaks below the pressure zone, the setup becomes invalid. And here's the short pressure zone trading plan. Find a bearish pressure zone. Sell below the next bearish bar that overlaps with the pressure zone and closes below it. The third bar of the pressure zone is acceptable if it's bearish. If the price returns once again to the bearish pressure zone and forms another signal candle, you can re-enter. And if price breaks above the pressure zone, the setup becomes invalid. Here we have an uptrend. This swing high maintained the excellent bullish momentum by moving above the previous swing high. After such a bullish move, expect the market to react with some bearish or sideways action. This low that formed couldn't close below the previous pivot low, implying that the uptrend is still intact. And here's our bullish pressure zone. These consecutive weeks signified that sellers were able to push the price down. Bulls drove price back up, showing strength. Since bulls overpowered the selling pressure by bears, there is the potential that their strength will carry forward, leading to an upwards movement in price. This is the signal candle, which overlaps with our pressure zone, so we buy above it. The low of this extended week provides a very prudent level for you to place your stop. The rationale for that stop placement being that sellers pushed price to the low of that week, but couldn't push it beyond that point. Hence, placing the stop just below that week is a level that has a lower likelihood of getting hit. And how do you know when to exit? This is probably the most difficult question to answer. It will depend based upon your risk tolerance. Sometimes it's best to take your profit quickly and walk away. Other times, you want to take some money off the table, move the stop to break even, and let the trade run. This discretion will be up to you. This example shows a bearish pressure zone setup. These three bars formed the pressure zone and gave us an opportunity to short the market. This was the setup bar, as it overlapped the area and was also bearish. The short trade has a decent follow-through, and as the market pulled back upwards once again, this was an excellent option, especially for traders who missed the first bearish pressure zone setup. The advantage of this strategy is that the pressure zone places less emphasis on the length of a single shadow and instead focuses on multiple shadows to find reliable signals of bullish or bearish pressure. But this price pattern has an important drawback. Consecutive bars with overlapping shadows also occur frequently within congested markets. Instead of taking signals and trades all over the place, the better trades usually happen at key price levels and when you take volume into account. So location of the pressure zones and volume are very important to filter those bad zones that are offering false signals. A good filter would be a common moving average. The 200, 100, the 50 period moving averages, or even the VWAP are worth having on your charts when it comes to finding key pressure zones. During ranges, moving averages lose some of their validity. But during trending markets, you'll see that those moving averages will work very accurately. So try to buy bullish pressure zones above a common moving average and sell a bearish pressure zone below a common moving average. Higher time frame support and resistance levels add a great layer of additional confirmation and confluence to these pressure zones. I especially look for strong and impulsive turning points where price has previously shown a strong reaction, because it implies that there is a lot of buyer and seller interest in such an area, and price is likely to show another reaction as well. Trend lines and channels are also great confluence areas. Trend lines are especially valuable if you are looking for potential pressure zones during trending markets when it comes to finding re-entry opportunities during pullbacks. When it comes to drawing trend lines, go for the most obvious ones with the most touches. My favorite dynamic support and resistance levels are pivot points. Pivot points are based on the previous day's high, low and close, so they don't change throughout the current day. I mostly pay attention to the central pivot point and S1 and R1 levels. So when you spot a pressure zone that forms at the pivot level, that's a high probability trade. Also, the take profit aspect becomes much easier. You exit a part of your position at the next pivot levels. If you found value and learned something new, leave us a like. This way we'll know if you'd like to see more videos like this one.
Trading success is heavily dependent upon being on the right side of the trade and executing the trade at an optimal time. But what does it mean to be on the right side of the trade? For a technical trader, this means you are trading with the trend, but even this statement is somewhat ambiguous. The problem is that not all trends are created equal, and there are multiple trends spread across many time frames that exist simultaneously. So how do you determine a strong trend? You have two choices: to use price action or to use trading indicators. To determine a strong trend, if you use indicators, you must optimize constantly. And since the market is always changing from strong trends to narrow trading ranges and then back again, you will find that your optimizations are based on what has happened recently, and that they will fail as the market transitions into a new phase. Many traders, especially beginners, are drawn to indicators, hoping that an indicator will show them when to enter a trade. What they don't realize is that the vast majority of indicators are based on simple price action. If there is a bull trend, a pullback, and then a rally to a new high, but the rally has lots of rejection bars, many bear bodies, a couple of small pullbacks, and wicks on the tops of the bars, Any experienced trader would see this as a weak test of the trend high, and this should not be happening if the bull trend was still strong. The market is almost certainly transitioning into a trading range, and possibly into a bear trend. What I'm trying to say is you don't need an oscillator to tell you this. The big problem of indicators comes when the market is trending strongly. If you focus too much on your indicators, you will see that they are reaching overbought and oversold areas, and forming divergences all day long, and you may find yourself repeatedly entering counter-trend positions and losing trade after trade. By the time you come to accept that the market is trending, you will not have enough time left in the day to recover your losses. Instead, if you were simply looking at a bar or a candle chart, you would see that the market is clearly trending, and you would not be tempted by indicators to look for trend reversals. Price action is far more important than any other information. That's why, let me share with you 15 price action signs I search for to determine a strong, healthy trend. First sign, the market breaks its previous swing high or low. Historically, trend was generally defined as a series of higher highs and higher lows for a bullish trend, or a series of lower highs and lower lows for a bearish trend. That's the first condition of a trend. Number 2. The distance between swing highs or lows. How far swing highs are apart is a sign of trend's trend. If the most recent swing high was far above the prior swing high, that shows the asset has a lot of buying interest and strength. If a swing high forms just barely above the prior swing high, the price may still be in an uptrend, but is not moving as strongly. The same for a downtrend. Third sign, most of the bars are trend bars in the direction of the trend. A trend bar has a body that is greater than 50% of the entire bar range. If a trend bar closes above its opening price, it's a bullish trend bar. If a trend bar closes below its opening price, it's a bearish trend bar. So when you read candlesticks, don't just look for classic candlestick patterns. It's much simpler to search for trend bars by analyzing the bodies of the candlesticks. If you see many bull trend bars, for example, you're probably in a strong uptrend. Number 4. There are very little overlap of the bodies of consecutive bars. For example, in a bull spike, many bars have lows that are at or just below the closes of the prior bar. Some bars have lows that are at and not below the close of the prior bar. So traders trying to buy on a limit order at the close of the prior bar don't get their orders filled, and they have to buy higher. The same for a downtrend. In a bear spike, many bars have highs that are at or just above the closes of the prior bar. This shows strength, and it's an important sign because the market is unable to go higher, and it keeps pushing lower. Number 5. There are bars with no wicks or small wicks in either direction. This indicates urgency in the market. For example, in a bull trend, if a bull trend bar opens and immediately trends up, traders were eager to buy as soon as the prior bar closed. If it closes on or near its high, traders continued their strong buying in anticipation of new buyers entering right after the bar closes. They were willing to buy going into the close because they were afraid that if they waited for the bar to close, they might have to buy at a higher price. Number 6. Gaps between the bodies. Occasionally, you will find gaps between the bodies of the candlesticks. For example, the open of a bar might be above the close of the prior bar in a bull trend, or below the close of the bar in a bear trend. A gap is a sign of urgency and a sign of market strength. 7. Trend bars after a gap. In some cases, a gap appears in the form of a strong trend bar. This is even more powerful. Not only the market formed an up gap like in this example, but it continued with a strong trend bar, indicating the conviction of buyers and their willingness to push price higher. Number 8. No retest of previous breakouts. You probably know the classic way to trade breakouts. You must wait for prices to retest the breakout level. A retest refers to prices reversing direction after a break and returning to the breakout level to see if it holds. In the case of a break to the upside, for example, after the initial wave of buying has run its course, prices may stall and trigger very short-term profit-taking selling. The tendency is for prices to return to the breakout level, which should now act as support and attract buying interest. But in a strong market, you will not get a retest. The buyers are unwilling to let the price drop lower. There is little profit taking after the breakout, so the price won't come to retest the breakout level. 9. No significant trendline breakouts. Plotting trend lines on a chart is one of the easiest way to get a quick idea on an asset trend and direction. A broken trend line is a technical sign that can suggest a change in trend. In a strong trend, you don't experience breakouts of significant trend lines. Number 10. Sideways corrections after a trendline break. So when a trendline breakout occurs, there's no momentum behind the move. There is sideways price action. A sideways drift occurs when the price trades within a fairly stable range without forming any distinct trends. Price action instead oscillates in an horizontal range or channel, with neither the bulls nor bears taking control of prices. So in the case of an upward trendline breakout, despite the fact that the sellers managed to push price below the trend line, the trend was strong enough to stop further downward momentum to happen. 11. Small corrections and sideways pullbacks. In an uptrend, we have more bull bars than bear bars. When we see this on our charts, this means that the bulls have more power and are increasingly moving the market upwards. Also, during a market controlled by bulls, the red bars are getting smaller as the bears can't drive the price down, so the corrections will be small, and in some cases the price action will appear in a sideways range. Conversely, during a market controlled by bears, the green bars are getting smaller. This price action indicates that the bulls can't drive the price upward. Again, corrections will be smaller when you compare them with downward waves. Number 12. The pullbacks have strong setups. For example, this pullback in a bull trend has a strong bull reversal bar as a signal bar. This is a clear pin bar. This pattern will attract many counter-trend traders. Why is that? Let's think logically. After a strong up move, there are many traders waiting to short the market. A strong signal like a pin bar or an engulfing candle will encourage them to short the price. This is basically a trap. The price moves aggressively higher, forms a pin bar, sellers enter, and the market continues to trend higher. Next sign. The pullbacks always have weak signal bars. It would be perfect to find a pin bar after a correction or an engulfing candle. This would add more weight to the setup. But in the strongest trends, the pullbacks usually have weak signal bars, making many traders not take them, and forcing traders to chase the market. There is a sense of urgency. You know the scenario. You find yourself waiting through countless bars for a good pullback, and one never comes, as the market slowly continues to trend. Number 14. Breakout bars have large bodies and small wicks. When the price finds support or resistance in its way, it usually manages to push through with a strong candle. The breakout bar that has a large bull trend body, for example, and small wicks or no wicks, it's a sign of strength. The larger the bar, the more likely the breakout will succeed. Number 15. Wicks below green bars and above red bars. In a strong uptrend, you will also see a lot of wicks below the green bars. This represents a good signal that the bulls are in control of the market and that are trying to push the price upwards. You will also see a lot of wicks above the red bars in a strong downtrend. This shows that the bears are in control of the market and that they are successfully pushing the price downwards, despite the initial reaction of the bulls. Charts provide far more information about who is in control of the market than most traders realize. Almost every bar offers important clues as to where the market is going. Prior highs and lows, breakouts, the sizes of bodies, and wicks on the candles tell a lot about what will happen next. So next time you open a trade, make sure you add these concepts into your analysis. If you learned something new and found value, leave us a like to show your support.